Before we jump into real estate, can we just take a moment and appreciate the rain we've had lately? I know my garden is certainly happy about it. After needing it for so long, it's been nice to see everything turning green. Well, hello everyone. I'm Missy Stegers here with your monthly market update. Each month, I bring you the latest San Antonio market trends from the previous month to keep you informed and ahead of the curve. Today, we're going to take a look at what's happening in the San Antonio market, and we also will hear from Jenn Bailey, my trusted lending partner, who gives you the financing update. Let's jump into the numbers. It's been an interesting month. Of course, you guys know interest rates have gone back up. April's market stayed active, but buyers definitely had more choice. Sold homes were 3135, which was up 2%. That was great. Average price just under 370. That was up 2%. Median price of 307, holding steady. Inventory continues to grow, however. 16,847 active listings. We now have over a 6-month supply of inventory. Homes averaging 87 days on the market. That means buyers can slow down a little, compare options, and negotiate more than they could a few years ago. More homes are hitting the market, and that's what's causing this. New listings up 11%. So good news for buyers looking for options, they have them. And for sellers, pricing, and presentation matter. It's important to get them both right. A quick look at Texas snapshot. Statewide, 29,970 listings, up 6.3. Average Texas price about $434, and the median for Texas is around $337. Financing is still a huge part of the market today. Let Jenn tell you a little bit about it. Jenn, what are we seeing right now with the rates and financing trends, and what should buyers know?
And let's talk about the month of April. So basically, April was a very volatile month for mortgage rates. Rates started out the month very stable, and then they moved higher as inflation fears and geopolitical tensions and rising treasury yields pressured the bond market. By the end of April, most 30-year conventional rates were sitting around 6.5%, and then government loans like FHA and VA were sitting closer to 6%. Let's talk about why. First of all, Treasury yields moved higher. Mortgage rates followed the 10-year Treasury yield much more closely than the Fed funds rate itself. And then in April, the 10-year Treasury climbed back toward the mid 4% range as investors worried that inflation could stay elevated for longer. Higher Treasury yields pushed mortgage-backed securities prices down, which translated into worse mortgage pricing. Second, the inflation concerns returned. The market became very nervous that inflation was not cooling as quickly as hoped. This has a lot to do with rising oil prices, energy prices, tariff concerns, stronger than expected economic data, sticky core inflation. Bond investors began demanding higher yields to compensate for future inflation risk, which hurt mortgage pricing. And then third, the Middle East. The Iran conflict pushed rates upward as well. So one of the biggest April stories was the escalation involving Iran and the U.S. The conflict caused oil prices to spike, inflation fears to increase, and Treasury yields to rise. Reuters noted rates that had been closer to the high 5% range earlier in the year before the Iran situation, and then pushed back up to the mid 6s due to the conflict. Now, the Fed held rates steady when they had their meeting. They did not cut rates in April. The Fed kept the Fed funds target range around 3.5 to 3.75. And they emphasized caution because of energy-driven inflation pressures, economic uncertainty, and concern that inflation could reaccelerate. So markets had hoped for more aggressive Fed cuts earlier in the year, but April basically pushed the expectations farther out. Now, housing demand did soften somewhat because higher rates can cause that. However, it held up a bit, purchase activity held up a bit higher than expected. So it seems to be that buyers are more adjusted psychologically to rates in the sixes because we've been here for a while. And in fact, we've come down from the sevens. And then spring purchase season created activity because it's just that time of year. If you look at the mortgage-backed security chart I'm showing, red is bad for rates, green is good, and being higher on the chart means lower mortgage rates. So as you can see, if you look at the chart, back in February, rates were doing really well. Right? That was before we entered the Iran conflict. And then since then, the rates have gone up and down, very volatile because of the conflict and all the things I mentioned earlier. So this is your April snapshot, and look forward to the next one coming in May, and fingers crossed things look even better. Have a great one.
Thanks, Jen. As always, real estate is a local and very situational product. If you're thinking about buying, selling, investing, or just wondering what those numbers mean for you, well, give us a call. We are here to help. We're here to take you into putting your house on the market or finding your home. Feel free to reach out with any questions you have, and thanks for watching this month.